The market is betting on the Fed's rate cuts, and the U.S. stock market is at a critical point. The four major sectors are poised for a 10-year bull run. As expectations for a Fed rate cut rise, Wall Street is quietly betting on the next round of major financial changes. When the market senses a turning point in liquidity, the U.S. stock market may be heading towards a decisive moment. Historical experience tells us that every easing cycle gives rise to a major market rally. And this time, the four major sectors could lead the bull run of the next decade. Hello everyone, I'm Chinking, a stock expert with 8 years of experience in the U.S. stock market. In today's video, I'll be giving you a detailed analysis of how the market is betting on the Fed's rate cuts and what opportunities are likely to emerge as we approach the critical point of the Fed's monetary policy. Before we start the video, don't forget to like and subscribe to my channel. Your support is the biggest motivation for me to update every day. In recent days, the U.S. stock market's upward momentum faced some challenges, with market sentiment remaining mostly cautious. However, today, Nvidia's surge became the key driver pushing the broader market higher. It's worth noting, though, that market breadth and the performance of short positions have shown signs of weakness. At this moment, Morgan Stanley released a new report, forecasting that the Federal Reserve will cut interest rates twice by 25 basis points each, in September and December. This prediction contrasts sharply with their previous stance, where they expected the Fed to keep rates unchanged until March 2026. At the same time, Warren Buffett is sending a clear signal to the market. His company, Berkshire Hathaway, is increasing investments in the U.S. residential construction sector, a segment highly sensitive to interest rates. This move suggests that Buffett is betting on a future rate decrease, anticipating a favorable turn in the housing market. As one of the most closely watched investors globally, Buffett's actions are often seen as a bellwether for market trends. So this increased stake is significant. Currently, adding to residential construction stocks undoubtedly strengthens the bullish outlook for this sector, further reinforcing market expectations that the fundamentals of the housing industry may be improving. Moreover, Buffett isn't acting alone. Some stocks in the housing and related industries have already begun to strengthen, from technical patterns to capital flows. More and more signals indicate that investors are reassessing this long-time, high-interest rate-suppressed sector and actively searching for new investment opportunities. Among the major brokerages, Bank of America Global Research is the only large firm still predicting that the Fed will not cut rates this year. According to market pricing, the likelihood of a Fed rate cut in September has risen to 82%, but the chance of another rate cut in October is only 42%. The market has already fully priced in a second rate cut in December, with the probability of 3 rate cuts this year at around 33%. Looking at the data, U.S. durable goods orders in July showed a month-over-month decline of 2.8%, much worse than expected. However, core capital goods orders recorded their fastest growth in nearly 3 years, indicating that business investment in the U.S. is strengthening. It's important to note, though, that this data can be volatile, largely due to Boeing's unstable order numbers and the front-loading effects of tariffs. Even so, most economists still expect business investment to remain weak for the remainder of the year. It's worth noting that Moody's chief economist, Mark Zandi, has once again warned that the U.S. economy is on the brink of a recession. He pointed out that economic recessions are often only confirmed in hindsight, and during turning points, data tends to undergo significant revisions. A particularly concerning trend is layoffs. In July, over 53% of industries in the U.S. experienced layoffs, with only the healthcare sector seeing job growth. Economists from J.P. Morgan have also raised alarms about a potential economic slowdown. They noted that employment data shows that over the past 3 months, the average number of new private sector jobs created has dropped to about 52,000. And virtually all industries, except healthcare and education, have seen stagnation. Analysts emphasize that when labor demand declines as economic growth slows, it is often a sign of impending economic contraction. For the stock market, bubbles typically form at the end of the economic cycle, and recessions often lead to their bursting. However, personally, I am not in a rush to be concerned. The reality is that the National Bureau of Economic Research, NBER, is the only authority with the power to officially declare the beginning and end of a recession. Founded in 1920, NBER is a private, non-profit, neutral economic research institution that strives to study economic phenomena scientifically and impartially. Though it does not provide specific economic policy advice, Interestingly, Trump has started paying attention to this organization. He believes that influencing the NBER is much easier than influencing the Federal Reserve. Speaking of the Federal Reserve, today they responded for the first time to Trump's dismissal of Cook. A Fed spokesperson stated that under the Federal Reserve Act, the terms of the Fed's board members are fixed and long, and the president can only dismiss them for just cause. This long tenure and protection against dismissal are key safeguards to maintaining the Fed's independence and authority. The Fed emphasized that they would continue to carry out their duties according to the law. Cook himself also publicly responded, stating that, from a legal standpoint, Trump did not have the legitimate authority to fire him. Cook's lawyer further added that they would take all necessary legal actions to prevent this illegal act. Although previously, the director of the Federal Housing Finance Agency, Bill Peltz, accused Cook of falsifying information in loan applications and being involved in mortgage fraud. These charges have not yet been adjudicated in court. The Department of Justice is currently investigating. In response, Trump said, "All right, we'll see you in court," and also revealed that he already has someone in mind to replace Cook. At a cabinet meeting, Trump stated, "I think we've narrowed it down to some very outstanding candidates. In fact, I might already have a clear candidate in my mind. We're talking to a lot of people, and they will all be part of the final decision process." U.S. Treasury Secretary Janet Yellen added that the Fed's independence is rooted in political arrangements, and public trust is the only factor that grants the Fed credibility. She is currently leading a comprehensive selection process, with many qualified candidates already on the list and in talks with the president. Recently, Trump made a shocking move that sent ripples through the market. He boldly announced on social media that he was firing Federal Reserve Governor Lisa Cook with immediate effect. In his post, Trump even posted a picture of Cook with a red X over her face, labeling her a fraud. It's important to note that Cook is the first black woman ever to serve on the Federal Reserve Board. Having been appointed by President Biden in 2022, her term was set to run until 2038. Well beyond Trump's presidency. The other two governors Biden appointed also have terms that extend beyond Trump's time in office. This unprecedented move immediately caused an uproar on Wall Street and within policy circles. If Trump succeeds, he would be one step closer to fully controlling the Federal Reserve. If Cook is forced out, Trump would have the opportunity to fill 4 of the 7 seats on the board, securing a majority. During Trump's first term, he appointed 2 of the current governors, and he has recently nominated his Economic Advisory Council chair, Stephen Moore, to fill Cook's prematurely vacated seat. This means Trump's 3-step plan to take control of the Fed is slowly unfolding. The market's concerns go beyond just the change in board seats. If Trump is able to secure a majority of seats before March next year, the new board may refuse to reappoint the regional Fed presidents, thus taking full control of the FOMC meetings. This could lead to a situation where future interest rate policies and monetary decisions are completely politicized by the White House. Experts believe that Trump's threat to remove Cook marks a significant escalation of pressure from the White House on the Fed. If successful, this would create a historic precedent in U.S. history. No president has ever actually fired a sitting Fed governor during their term. The question then arises, does the president have the power to do this? The answer is yes, but only under very strict conditions. The Federal Reserve Act explicitly states that the president can only remove a governor for just cause, such as severe misconduct, dereliction of duty, or incapacity to perform duties. However, the president cannot use this power simply due to political disagreements. In fact, the U.S. Supreme Court recently hinted in a similar case that the president cannot fire a Fed governor purely due to policy differences. In other words, the Fed is meant to have some degree of constitutional independence. However, the boundaries of this legal area are not entirely clear, as no president has ever attempted this before. This is why Wall Street is concerned that Trump's actions could trigger a constitutional crisis and further exacerbate long-term market volatility. Looking back in history, even during the fierce confrontations between President Johnson and Chairman Martin, or Nixon's pressure on Burns, no president ever crossed the direct firing red line. Currently, the market's reaction to this news has been relatively calm, but analysts warn that if the Fed's independence is eroded, the seeds of lost trust will be planted. It is uncertain how quickly this will affect policymaking and market pricing in the future. I believe Trump may not succeed in firing Cook, and this could actually elevate the position of the Fed. After all, Fed appointments require Senate approval. And whether Democratic or Republican, senators typically support the central bank's independence. The market now expects the Fed to officially begin rate cuts at its September 16th to 17th meeting. Cook has already stated that she will continue to participate in policy discussions. In other words, under Trump's strong intervention, the decision-making process, which was previously private, might become fully transparent to the president. The market will naturally recognize that future monetary policies may have stronger political motivations. Some worry that Powell may have already compromised, and a rate cut in September seems almost certain. But the real question is whether Trump's interference could have the opposite effect on the market. Many believe that this attempt to fire Cook could be a turning point. It suggests that the Fed could gradually be reshaped by the president's will. After all, no one is perfect. And if we look back over decades of history, almost no Fed governor has avoided some degree of controversy. At this critical juncture, many people are unwilling to directly confront Trump. Today, during the market session, the Federal Reserve's Barkin also began to soften his tone, stating that if the economy maintains moderate growth, interest rates will also adjust moderately. Analysts pointed out that the baseline scenario now is that by 2026, the Federal Reserve will undergo significant Trumpification. This doesn't necessarily mean a dramatic shift in policy, but it will lead to a noticeable break from how the market has traditionally reacted to Fed decisions. I believe the U.S. is at a very delicate juncture right now. On one hand, there's the political pressure to intervene in economic data. On the other hand, there's the Fed's mission to maintain independence and economic stability. Moving forward, we need to focus on two key questions. First, is the Federal Reserve's independence the result of legal protections? Or is it merely upheld by long-standing practices? Second, how important is this independence to the US and global financial markets? In the short term, rate cuts are undoubtedly good news for the market. But in the long run, if the Fed's independence is eroded, it could lead to a steeper yield curve, higher inflation compensation, and an increased inflation risk premium. To sum it up, short-term gains, long-term risks. Some have joked, what happens once will happen twice. And then some, Trump is gradually building his empire, from the legal system to Congress, and now the Federal Reserve. It seems there's nothing he won't do, or can't do, only the world has never seen anything like it. Alright, that's all for today's video. If you found today's content helpful, don't forget to like and subscribe. Thank you for watching, and I wish you success in your investments. Remember, the stock market carries risks and investment requires caution. I'm Chinking, and I'll see you in the next video.